Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. Here at ADISA, we're committed to providing thought leaderships and insights on alternative investments. My name is Greg Mausz. I'm the host today, and I'm joined by Brad Updike, an attorney with Mick Law. Brad, thank you for joining the show.
It's good to be here.
Today, we're going to be talking about 1031 exchanges, but taking a different twist. And rather than talking about real estate, I want to talk about oil and gas 1031 exchanges.
Sure.
But before we go there, I want to make sure that everybody has the basics on what a 1031 is.
Okay. That's the basic rules that apply to like-kind exchanges. It's found in Section 1031 of the Internal Revenue Code, which allows a taxpayer to sell commercial or investment real estate, and they can reinvest those proceeds in real estate of a like kind, and if they follow the rules that are set forth in the Treasury regulations, and they can defer that gain indefinitely.
And that's a very powerful tax planning tool.
Very much so.
And you can do that as an individual, but here at ADISA, there's lots of securitized 1031s. So can you touch on that and how 1031s can securitize?
Oh, sure. I think you start out with the premise that we have $17 trillion worth of commercial and investment real estate that's in the United States, and it's 90% privately owned. Now, REITs and your private equity firms, they own a pretty good sliver of that, probably 35%. There's 4 to 5 trillion of that 17 that's in REITs and in the private equity funds. But, that leaves the remainder, which is held by private companies, individuals, and families. And a lot of times, these private families that own real estate, they find themselves in situations where they are fortunate enough to sell at a very sizable gain, which is good from a wealth generation perspective. But at a lot of times, the families, they'll just take their money, they'll pay the tax and again go on their merry way. But for some families, they want to stay invested in real estate, and these securitized products can fill a much needed planning gap.
Absolutely. It allows for professional management. They still get monthly checks. They still have the estate planning and tax advantages. So it works out really well. And I've seen over the last 20 years a lot of 1031s in real estate, but with the growth and interest in energy, I'm hearing it come up more and more on the oil and gas side.
It is.
So can you explain a 1031 exchange using an oil and gas asset?
These are programs that are basically going out and they're buying royalties and mineral rights, and they hold these assets on behalf of a group of accredited investors that have placed money into the program, a lot of times in order to fulfill a replacement property requirement within their 1031 transactions.
So you're telling me that oil and gas assets are like kind to all the different other types of real estate assets?
That is correct. Under the code definition of real estate, it just has to be of a like kind. Real estate for real estate. So based on the very broad definition of real estate, improved property can be traded for raw land or even oil and gas mineral rights, because mineral rights and royalties that come from those mineral rights are considered real estate for state law purposes.
Okay. So now that we have the like-kind exchange here on this 1031, is it structured as a DST or is it structured as something else?
It could be structured as a DST, but as many people know, there are certain restrictions upon what the program manager can do with the property, and that doesn't really work very well for holders of mineral rights and royalties, because there are certain transactions where the holders of these assets need to renegotiate leases, or they may need to make equity contributions, and you can't do that with a DST. On the other hand, if you use the direct fractional interest type structure, you've got a little bit more leeway in terms of what you can do from a managerial perspective with these assets.
Direct fractional interest.
Yeah, it's like a TIC.
Okay.
Like what the real estate sector used to use.
Okay.
About 15 years ago.
Wow. So it's back again, but in oil and gas.
Yeah.
Okay. fantastic. So is it the exact same process where you're identifying the assets in the time period and then closing within the 180 days?
Works a lot of the same way. You still have the 45-day identification period requirement. You still have to close on the property within 180 days, and then you have to use the qualified intermediary to hold those proceeds. So the same fundamental rules that apply to conventional real estate like-kind exchanges also apply when you're using oil and gas assets.
Great. So next question would be about leverage. Many people have leverage on their real estate. How does leverage work in these types of deals?
We don't see much leverage in the oil and gas transactions that have come out and have been syndicated presently. So really, when you're using oil and gas 1031s, this will be for a taxpayer that doesn't have debt. Maybe they sold property just without debt or any leverage, or it could also be part of a combined scenario where you're maybe using multiple securitized products in order to meet that need. And maybe they can use a DST in order to match some of their debt if they have it with debt of the DST, and then they can also use an oil and gas product on top of it to get some diversification from a product perspective.
No, that makes a lot of sense. Diversification is a very powerful financial planning tool. So if I'm looking at this, you're using the term working interest and royalties. I hear a lot about drilling programs. So you're not talking about doing a 1031 into a drilling program. You're doing a 1031 into some type of income producing oil and gas assets.
Right. Mineral rights, royalties, and overriding royalties. Technically speaking, I mean, you could do a 1031 exchange into a working interest type program. The problem is, though, in order to drill the properties, which is what working interest owners do, that requires capital contributions, and you can't do that. But with mineral rights and royalties, those are more passive. And in that type of situation, really, the mineral interest holder, the holder of the royalty, is actually the lessor. They're basically, what they've done is they've leased their drilling rights to the working interest owner, who's an oil and gas company, an established oil and gas company with a pretty sizable drilling budget, and it's going to go in and drill the properties.
Okay. Talk to me about return metrics now. Is it comparable to real estate, better than real estate?
It has to be better than real estate for a couple different reasons, because you're taking on more risk. A lot of times in these portfolios of oil and gas mineral interest, you'll have properties that produce oil and gas, and then you'll have properties that are nearby and that are going to get drilled in the future. So there is an element of risk there. So therefore, the return profiles for these oil and gas programs with the 1031 component are higher. And comparatively speaking, on the DST side, your IRR profile may be 6 to 8%. That's including the income that you get plus the sale proceeds. With an oil and gas direct fractional interest program, your return profit is going to be more like 12 to 16%.
Oh, wow.
It's going to be about double.
That's material.
That makes sense based on the risk that they're taking. Because a lot of property has to get developed in order to maintain that return.
So if advisors and investors are analyzing various options, what are some of the key considerations that they should consider when looking at an oil and gas 1031?
I would say just the percentage of the property that's drilled versus the property that's not drilled. Your better, more safer, or the better and safer oil and gas programs are going to have a reasonable mix, maybe 40-60 between the assets that actually produce and the ones that will be drilled in the future. I think it's also important to look at the primary operators of these properties. I mean, and who's actually going to be doing the drilling. And you want to be in an area where you've got companies with scale and that are actually going to drill over the next couple of years, regardless of what the oil prices are.
You're right, because you're a passive investor, so you want to be in the path of progress so that they do drill and that you do get that income.
Right.
I would imagine the income would be more variable on an oil and gas
Very
1031 than a real estate 1031.
Which is another reason why the DST really doesn't work well, I think, in the oil and gas space, because with an With these DSTs, they use the master lease, in which case, you've got a sponsor that's coming in. They're going to be the master tenant, and they're going to pay a fixed income payment to the investors. Here, oil and gas markets have been very volatile over the last 20 years. We've had 4 or 5 pricing cycles and changes, significant changes over the last several years. So putting together a lease with a fixed payment, that's pretty tough to do unless you've got a very good hedging program.
Which, I mean, there's tons of hedges out there, so that can be done.
It can be.
So if I had to summarize some of our key takeaways here is that, securitized 1031s in oil and gas, very viable product, a little bit higher risk, but you get a little bit higher return out of it. And it's probably a diversifier because there's not leverage. So it has to be that right fit for that right client. So it doesn't cause any type of boot issues.
And you do get, good basin and operator diversity because a lot of the way that these sponsors actually put these portfolios of mineral rights and leases together, it's usually in multiple basins, multiple fields with different operators.
That diversification sounds ideal.
And some of the basins, produce more oil, some produce natural gas and liquids.
Splitting up commodities.
Another good thing about having some money on the oil and gas side of it is the depletion allowance that you get. It's a pretty powerful tax advantage that applies to oil and gas mineral rights ownership, and it allows the investor actually to take 15% off of the gross production revenue.
Gross, not net, too.
Yeah, it's gross, not net.
Another great tool because, oftentimes these programs are throwing off a lot of income, so any tax advantages is helpful. So.
Yep.
Well, Brad, thank you for walking us through the details of a 1031 oil and gas exchange.
Absolutely. It's been a pleasure.
And thank you for watching another episode of Focus on Alternatives. For more educational content, please visit adisa.org, and we'll see you on the next episode.